Hey, good morning, everyone. Your investment advisor, Bill here. We're going to do a quick market update for Saturday, April 18th. It's about 10:30 a.m. I just want to run through a few charts with you. So I am already screen sharing with you. So take a look at your screen, and you can see here that the for the week ending the 17th, the gold market was up 4.71%. The silver market up 4.49%. The Russell 2000 up 2.63%. We have the Vanguard Intermediate Bond Fund up 0.89%, which means when bond funds go up, interest rates are going down. Okay, so bonds were up a little bit as an interest rates were down a little bit on the week. Here, the S&P 500 eked out a 0.28% return for the week, which is crazy to me because the market is up 1,400, down 1,500, 2,000, down 2,000, up 500, down 600. So for as much volatility as we've seen this week, the market was basically unchanged. And that's really what volatility is all about. It's these extreme highs and lows, and then we kind of go right back to the middle like a pendulum of a clock. The NASDAQ QQQ, which is the technology heavy ETF, was down 0.7%. 10-year US Treasury index, which this means is interest rates on the 10-year US Treasury bond were down. So that means interest rates were lower on the week. And a very important metric, the US 10-year Treasury down 1.39% to 4.333. The US dollar index is down 1.48, and this is the most important chart of the week. I'm going to get rid of this volatility chart. Volatility was down 27%, which means things are calming down. Find it hard to believe, but it's true. I wouldn't lie to you. Here we are. One of the most important is the US dollar index. And why is this important? Because in 2021, when interest rates were at their post-COVID low, when we were just pumping all sorts of money into the economy, interest rates on the US dollar hit a low in 2021, and the market was at a high. Right? Remember that incredible rally that we saw post-COVID? Well, here we are. The US dollar rallied huge, mainly because of interest rates, right? US dollar rallied huge. And what happened to the stock market when the dollar rallies? Boom. Here's 2021 up here. The stock market gets hit huge in 2021 into 2022. We saw companies like Facebook go from $350 a share to 70. Coinbase went from 350 to 45. Moderna went from 500 to what's now 27. So a rally in the US dollar means a decline in the stock market. A decline in the US dollar means a rally in the US stock market. So then let's go back again in time. Once again, we see the US dollar rallying from the end of 2022. I'm sorry, this is the S&P 500. The S&P 500 rallied from the end of 2022 up until 2025, until this year. Basically, we had a huge stock market rally, and that came, not surprisingly, from a decline in the US dollar. All right, decline in the dollar, huge rally in the S&P 500. And we saw it again. The dollar began to rally from 2024 into end of 2023 into 2025, a big rally in the dollar. We should see the opposite in the market. Ta-da! Here we go. We saw this big rally in the US dollar, and we saw a decline in the stock market. Okay. Now, there's a lag time period here as to when the dollar peaks and the market hits a low, or when the dollar hits a low and the market, as the dollar declines, the market goes up. And so here's a chart of the S&P 500 that was declined. Here's a chart of the US dollar. It broke a new low. So this decline in the dollar, we should see a corresponding rally in the S&P 500. And I think this was happening here. Donald Trump wants to bring the US dollar down. And that's his deal with China. We'll deal with tariffs, but we're going to lower the US dollar. And so what I think we're going to see by the end of the year is a massive rally catching everybody off guard of the S&P 500 to a rally making a new high in the 62 to 6,500 area, like somewhere up here. Rally in the S&P 500 due to a massive decline and a new reset in the dollar since COVID. So we're kind of resetting everything that happened back in the old days, a number of years. So just keep that in mind. All right. Dollar weakness means strength in an index. And why is that? I have to stop my screen share and then share a different screen, which is an Excel spreadsheet. And I'll tell you why. Because here we can see as here's the S&P 500 at roughly 5282. If you in math, numbers are expressed mathematically by a number that's divided by one. So my weight is 180 pounds. Expressed mathematically, that's 180 divided by one. My home price is 300,000. It's 300,000 divided by one. So when you divide a number by one, you get the number, right? That's what we do in America. That's what we do here. But when you divide by a higher number, the denominator gets when the denominator gets bigger, that means the number drops. So when the dollar rallies, the actual number declines. And so a 9% rally in the US dollar equates to almost a 9% decline in the S&P 500. It's just math, right? And when the dollar declines, if it drops by 10% or so, you see a corresponding rally of around 10% in the US dollar or in the S&P 500. So as the dollar increases, the denominator, the whole number decreases. As the denominator gets less and smaller, the bigger the result is that number gets bigger. This is why the market continues to rally over the years, over the decades, because the US dollar is losing its purchasing power. So let's go back and share another screen here. Just stay with me. We're almost done. So we finished up the two charts. We finished up the S&P 500. Again, I think the low is in. This is exactly what the chart pattern looked like in 2018. So I think we may possibly trade a little bit lower, but I think we're off to the races by the end of the year, God willing, if everything goes according to plan. All right, here's the 10-year yield. You can see that interest rates peaked in 2023. We've been trading sideways, but obviously this arc is going lower. We're in an interest rate declining market, which will be very good for the dollar. Lower interest rates, lower US dollar, higher S&P 500. It's all about the math. It's all about relationships. So yes, we did see a rally in the last few weeks in the of interest rates. The interest rates kind of went up and then they went down, and so we're just watching this ebb and flow. But this red box here means it's a sell signal. So one of the two things are going to happen is that we might turn around and decline and make a new low in 10-year bonds around 3.5 to 3.6%, which is what I think is going to happen. Or we may rally back up again just a little bit to spook everybody. But I think again the trend is clearly lower in interest rates, clearly spelling out more a calming of inflation, and we're seeing it in other commodities across the board. And here's the last chart I want to bring to your attention. There's a lot of discussion out here about how bad the U.S. market is and how good the emerging markets and the EU markets and London and Germany. So after the internet bubble burst, we saw our U.S. markets decline and emerging markets do really well. Yes, that's right. So we saw the emerging markets do well in '03, '02, up until the Great Recession. When the Great Recession hit, our markets did really well. So this is emerging markets divided by the S&P 500. So when our markets do well, emerging markets do horrible, right? So we're still in a scenario where the US dollar is dominating emerging markets in the developed countries. So just because you hear how great emerging markets are, how great other countries are doing, like we need a little bit more time for this to play out. Yes, this last month or two, emerging markets have done well, but our S&P markets clearly, our US markets clearly outperform and dominate anything that's going on overseas. Okay. So we have to keep an eye on this relationship. We are at the low level as we were after the dot-com bubble burst and say the Great Recession housing crisis in 2006 to 2007. Will we turn around and see the emerging markets and developed markets go back up again with respect to US? Don't know. Too soon to tell. So we have to keep an eye on that. If we do see that, we're going to be selling some S&P 500, some NASDAQ QQQ, some of the RPG, which is the U.S. growth index. But for now, U.S. still dominates and growth dominates. And so I think that trend is going to continue for at least a few more years. So anyhow, thank you so much for tuning in and for your patience to listening to this somewhat sometimes often unexciting commentary on the stock market, but it's really important to me. I love what I do, and I'm doing what I love for you. So thank you so much for your time. Have a happy Good Friday, happy Easter, Passover, and we'll be in touch again next week. And yes, we are all exhausted of this market, but I got to be honest with you, the energy is exciting for me. I run to this, right? I love this because this is where we get opportunity. So again, thank you very much. Happy holiday, and we'll chat with you soon.